We're focusing on trading following Jerome Powell's statements from last night. Bill Baruch, president of Blue Line Futures, joins us today to talk about the trades he's putting on. Bill, how are you reading the markets? Yields are up past 1.7, 1.73, the latest I'm reading on the 10-year. It's whatever gains we've had in the gold and equities markets last night seem to be reversed today.
Yeah, it was definitely surprising to see everything turn. Was it really that surprising to see another nosedive in the bonds? Not really, I guess. I mean, I've been thinking that we're going to bottom out here, and ultimately, it just hasn't stopped. And this is the bond market, treasury market, for that matter, is one of those that when it starts to move and the floodgates open, it's a tough one to stop. And so there's a number of narratives around it. I mean, the Fed, don't get me wrong, the Fed was very dovish yesterday. But the problem with just being dovish, it's not enough anymore. And you look back a couple of weeks ago when Fed Chair Powell was doing an interview with the Wall Street Journal, it came up with as yield curve control, and they weren't thinking about yield curve control yet. So what you see, you saw the longer duration bonds in the 10-year as well dove lower, yields spiked, and some panic ensued in the equity markets. Tech is one that's getting hit the hardest. Yesterday, though, he covered the underemployment and a very big emphasis on some of these jobs, how they're never going to come back. That in and of itself is dovish. You look at some of the data that they put out, the PCE at 2.0 to 2.2 up through 2023. They don't expect any inflation. That in and of itself is dovish. But there are some other things that the bond market wants to see at this point, and really that's the SLR, the leverage ratio for banks, and banks own treasuries right now that don't count against their equities. And that exemption is up at March 31st. They haven't extended it yet. Maybe they shouldn't extend it, but that's an argument for another conversation. And that encourages some selling because the banks now got to raise cash for their equity. And then the yield curve control, of course. So there's a number of reasons why the bonds were not satisfied with it. And as they went lower overnight due to Norway Central Bank being a bit more hawkish, they're going to hike rates later this year. News that the Bank of Japan is going to potentially let rates trade more freely, which means higher rates as well. So all this has been bearish for the bond market, and it's digesting that here. And so you got the reversal you talked about here. Tech sharply lower, stocks overall lower, and the metals reversed pretty sharply.
Is this a technical correction, or is it a complete shift in sentiment from last night to today?
Listen, I mean, as a futures trader that trades leverage, I mean, these are volatile markets. But on the equity side, as an investment advisor, I mean, they don't seem as volatile as they do as a futures trader. I think it's if you have a good game plan on the equity side, I mean, there's definitely money to be made in different areas, and same with the futures. But intraday, these are some vicious moves we've been seeing in the futures, like what gold has done, and trading up to in the 1750s and then back down below 1720, and all within less than 12 hours. So yeah, there's definitely some volatility out there, but I do think there's some good opportunity if you have the patience.
Okay, so let's focus on bonds and the yields now. You were calling for higher yields for quite some time. I remember we spoke a couple months ago and we followed up. So you've made that correct call. I mean, people at the time didn't really believe you because no one expected yields to rise when they were low. But now, of course, we've seen what happened. What's your sentiment now? Can it run even higher?
Yeah, well, I do think we're within a peak area, at least for the intermediate term. And don't get me wrong, I am a bond bull. I have been for a very long time, and we've done very well being a bond bull for a very long time. I called this in September to October when I started to change, how I felt about the treasuries in the intermediate term. I called this an intermission. So at 60 basis points, I was looking for 1.5%. And we got there, and the fear that I was sort of putting out there at that point was a fast, high velocity move from 1.25 to 1.5 or just above 1.5 is what's going to spook the markets a little bit. And that's what we're seeing play out. Now, it has continued to go higher. I do think this region, 175, let's call it, even like 1.6, is historically a very big area in the yields. Many lows were put in between 1.4 and 1.6 going years back. And that was a very big area. So I think that everybody's looking for 2%. I don't think we quite get there. So I think I guess I am calling the top in the yields. I guess I am calling a bit of a bottoming process here in the bonds. I think we're closer to the end than the middle. of this move in the bonds to the downside or yields to the upside.
Okay, we're going to talk about your trades in just a minute. So just to sum up, you think yields are going to come back down from here. That could be good for both equities and the precious metals, right?
Absolutely. I think the yields pull back just a little bit, and it's they settle in. I don't think the move over this intermediate term is not necessarily done. So explain that in a minute. I think what we've seen here now, this move up to 175 in the 10-year. I think we're in the very later innings of this move. I think we pull back. Then maybe somewhere the yield talk of 1.25 and settle in, and that's going to be very bullish. But as we look to turning into 2022 at this point, later this year, at that point, I do think that we could see the yields rev up one more time, because they're going to have to talk about tapering. And I think at that point too, we're going to have more of a better picture on the reopening, a better picture on the jobs and what jobs are coming back. And where is inflation at that point? And one of the tailwinds that the Fed has right now is there is no inflation by the metrics that they use. We all know that inflation is out there, from lumber prices to energy prices to agriculture prices. It's real. It's there. Housing prices. So the Fed has a bit of a Goldilocks situation on their hands for them to remain dovish. But at the same time, that's why the bonds keep going lower, the longer dated, because that inflation is going to show up. And then they're also printing the fiscal policies. They're printing new money that has to, it's supply in the bond market. And that demand to buy those bonds is not meeting that supply right now.
Yeah, I think they were, the way I see it, they're trying to avoid the same mistakes that perhaps some other central banks made in the last financial crisis, raising rates too soon because they think inflation's coming. And that didn't work out very well for the markets.
Well, exactly. That's what they got in front of last year. It was the symmetrical inflation targeting. They were going to allow inflation to run as hot above 2% as it was below. So they're looking, again, 2.0 to 2.2 inflation range for PCE. That's their preferred inflation indicator, core PCE, by 2023. So there's no inflation. They don't really expect any inflation. That doesn't give them a reason to move, but they do want to see full employment. And that's where employment really comes in. And that U3 rate is about 6%. It's the U6 rate that is 11% right now. And that's the underemployment. So people that have fallen out of the workforce, and that's what really worries the Fed, and that's one of the reasons why they should remain dovish.
Okay, so perfect segue, and I'm just going to read part of Jerome Powell's statements from last night. People were asking him about his conditions for liftoff.
We've laid out what I think is very clear guidance on liftoff, and it's really three things: labor market conditions that are consistent with our estimates of maximum employment. And as I mentioned, we consider a wide range of indicators in assessing labor market conditions, not just the unemployment rate. Inflation that has reached 2% and not just on a transitory basis, and inflation that's on track to run moderately above 2% for some time.
Will any of that happen anytime soon, you think?
Listen, I was thinking we would see CPI and PCE really move, through 2% in the first quarter. I was wrong there. I did get the Treasury, the rate story right, and that's what mattered really. That's where you're invested. You're not invested into a CPI indicator, and I'm surprised. I am surprised that we haven't seen it, and it gives me the idea that we may not really see it by the measures that we actually feel it and where our pocket is. So I think that's we'll find out. But I would not be surprised to see it contained the way they are. Listen, the Fed has done a terrific job. There's a lot of Fed haters out there. They'll pick and choose little things that they've done wrong along the way. They've done a terrific job. I hand it to them. Bravo.
Yeah. So you think so based on what you said, you think they're going to keep rates low for quite some time then?
Yeah. It wasn't even half of the committee members that would expect to see a rate hike in 2023. I think it was 7 out of 18 members. So I think there's gonna be some work to do to even get them, halfway there.
Okay. Let's talk about trades now. Let's start with the future side. How are you positioned now, given the statements from last night?
Listen, I like holding some gold. I don't over leverage. One of the ways I position in futures is I like to say that I don't have to be right now. So the CME micro contracts are great, and you can pick up a few of those per $100,000, and kind of hold those, be patient with them. So I do like metals exposure. I love seeing how the metals are able to battle higher here, even as the treasuries go down. These legs lower in treasuries, as we saw last Friday, as well as through this week, and then gold sort of kind of elevates up. I think there is some rare earth magnetism there, I guess, so to speak. That's palladium, what has done just a massive run this week, dragging gold up, or really dragging silver up, and then silver's dragging gold. Silver's performed a bit better. So I like silver and platinum, and I do hold the fact that I do think silver and platinum will continue to outperform gold this year. I like both of those. On actually trading it, platinum is a tough one to manage risk with sometimes. So it's just you do got to be a little careful. But I do think they're all going to perform better. And then some of the ways I'm cautiously trying to pick a bottom in the treasuries. Some different ways you could look to do that. I mean, buy some just managed risk call spreads. Use a stop in the 10-year. So I am playing to the upside, looking for the treasuries to rebound sometime over the next 30 to 60 days. And those are some of the positions. And then energies as well. I mean, this crude oil is just getting clobbered. I think it's down more than 6% right now. It's the day of reckoning that crude has been sort of, it was around the corner. And it usually happens after these contract expirations or options expirations. So the April options expired yesterday. And you're getting that sort of rollover right now. Yeah, there could be some fundamental news that's moving it. There always is. But this I think was a positioning move. And we've been talking about being short April as the market got a little frothy. We've been bullish crude, but being short the April contract and being long the December contract, because there's been this really steep backwardation. You've seen the April contract trading at about as much as a $5 premium to the December. And we do believe that comes in. Today, that's down to 240. So that's something we've been playing with. I even had talked about earlier in the week in some of my write-ups of rolling that short April into a short May contract. But now that we're down at our target has been 230, 240, we're moving into the close. So we'll probably sort of close that out today and then look to reestablish it back to closer to $4. We want to be buyers in crude oil, though. So we're going farther out month-wise, potentially looking like a September contract and look to position maybe coming out of the weekend, or maybe buy some call spreads ahead of the weekend, just so we can manage risk. I don't want to see any news in the weekend that could slam this market lower and really, gap lower on futures. So one of the better ways to do that would be buy some call spreads. Your risk is out there, and you avoid any crazy moves in the market or news.
Okay, let's talk about the equity side now. The S&P 500 is still up year to date, but just on the last 30 days now, Bill, last month it's gone nowhere. It's been flat. What's happening now?
Yeah, it's a push and pull. You get tech, down sharply, and as the Nasdaq is, and then which Nasdaq got up to 13,900, and it's fallen sharply. It's been about 12,200, and it's struggling to regain 13,000. So you got the Nasdaq. What is that? 5, 6, 7% from its record high at maybe more, or you got the S&P that's at record high, set a new record high last night, and I think push and pull here. The Dow Jones is actually higher today, so industrials are doing well. Energies again are having a bad day today, but energies have been on fire. Banks have been on fire, so you got some good leadership in the market overall. And it's just we're at a time where it's not all about tech. I do think tech will have its day, and that's where active portfolio management becomes very, very important, and trying to figure out what's going to be the next cycle or rotation.
What sectors do you like now then?
Listen, our largest positions have been and continue to be in the small caps. We use IJR, KRE, good regional bank, just broad exposure, avoiding idiosyncratic risk. So those are two that we like a lot, but we love industrials that include things like Raytheon and Kansas City Southern, and but as we've seen weakness in some of the tech, I've been buying Apple and Google, and so I think it just kind of staying diversified. But again, our larger positioning right now is looking at these banks continue to go and the small caps continue to go until there's a reason that tells us that they're not. And again, that could come any day, any week, and that's why we're always vigilant.
Perfect. Thank you for your update, Bill. Appreciate it.
Thank you.
And thank you for watching Kitco News. Don't forget to subscribe. I'm David Lin.